Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Peter Westaway, author of the Hedder series European Market Narrative, to discuss how EU markets are reacting to the recent US Fed interest rate decision. Peter's a former chief economist and head of investment strategy for Vanguard Europe. He's also held positions at HM Treasury and the Bank of England. Peter, it's great to have you with us. Welcome to Trade Talks.
Thank you very much, Jill. Great to be here.
You got it. And as an EU economics expert, what are a few things investors should understand about European central bank policy and rate hikes?
Yeah, well, I'd say the most important thing about predicting the European Central Bank is that no one has ever made money by expecting them to be dovish. They've had a long history of being hawkish. True, President Lagarde has moderated the German, more hawkish tendency from the German representatives on the Governing Council. But even now, the risk is that the ECB will raise rates too far and overreact to potential inflation risks, even as the headline rate is now starting to fall quite quickly.
Peter, do you think interest rate hikes will get to the levels that we saw in the 1970s?
No, I don't think so. Nowhere near, in fact. So we saw the ECB raise rates to 3.25% early this week, and I'd expect maybe another 50 basis points to come. If they reached 4% or more than that, that would be a big mistake in my view. Of course, a lot of people are making comparisons with the 1970s, but remember, we have a well-defined inflation target for the euro area now, as we do for the Bank of England and the Fed, and that's helping to keep inflation expectations under control, and so should prevent interest rates getting too high.
How are EU markets reacting to the recent US Fed interest rate decision?
Well, I'd say in Europe, and probably globally too, markets have been slightly soft since the rate decisions by the Fed and indeed by the ECB. I mean, as expected, both central banks signaled a slowdown in their intended pace of tightening, but there was maybe a little bit of disappointment in the markets that the Fed maybe could have held off hiking altogether in the light of the collapse of First Republic. And that's maybe contributed to a little bit of weakness at the time of that decision.
Inflation is still persistent in the US. How does the market landscape compare with the EU's based on this trend?
Yeah, well, I'd say one big difference is the market jitters over the banking sector weakness in the US, which I don't think, incidentally, is necessarily completely over yet. And then the other main difference is that a large part of the strong inflation in the US is driven by strong demand tendencies. And that's partly a legacy of the strong fiscal support that was given during the pandemic. Now, on the other hand, inflation in Europe, including the UK actually, has largely been driven by the cost pressures caused by higher commodity prices, higher food prices that have been caused by the war in Ukraine. Now, the Fed really do need tighter policy to squeeze inflation out of the system, although the banking sector turmoil may be helping them a little bit in that regard. But in Europe, while there's an element of needing tighter policy, I think automatically as the cost shock drops out, so inflation is going to come back a little bit more automatically. And so maybe things aren't quite as urgent there.
Speaking of the UK, the BOE raised interest rates to almost 5%. Why is the UK following similar patterns as the US?
Yeah, I mean, it's true that the UK does tend to have higher rates than in Europe and tend to be a bit closer to the US. And I think we're seeing similar messaging from the Bank of England as with the Fed, that rates need to be hiked, but maybe we're nearing the end of the hiking cycle. And after that, I suspect we might actually see interest rates in the UK falling back more quickly than in the US, because inflation is going to fall very sharply because of those cost shocks dropping out, and we're going to start seeing growth perhaps stagnating more than elsewhere.
What can we expect to see in the second half of 2023 in terms of inflation and interest rates? You just touched on that, but is there light at the end of the tunnel for investors?
Well, I think there may be some light at the end of the tunnel, but when there's always a chance that light could be a train coming straight at us, which is always the risk. As I said, in Europe, inflation is going to fall back sharply. In the US, it will fall probably more slowly, albeit from a much lower level. All round, interest rates are going to stop increasing. The hiking cycle is pretty much done. The expectation is that they'll peak out probably slightly above where they are now and stay there. My guess is that they may actually start to fall back again as these inflation risks recede and we start to see the growth prospects looming larger.
Do you expect any regulatory changes in the US or EU based on the banking industry landscape?
I'd say probably not, but I would also say we need some. I think that the banking sector travails have really shown that the lessons of the 2008-9 financial crisis have pretty much been forgotten already. I think there's a strong instinct to deregulate, and I think that needs to be reined back. To be fair to policymakers, equity holders are not being bailed out explicitly this time, but compensating depositors above the minimum limits is arguably a backdoor form of taxpayer finance bailout. And it's also true that I think many of the regional banks in the US have got insufficiently diversified balance sheets. So I think there is a lot of work to be done on the regulatory side from a kind of financial stability perspective if we're going to avoid further crises.
And finally, Peter, what are you thinking more near term, let's say in the next 30 days, as you look at what the market and central banks are doing?
Yeah, well, on the banking side, I'm looking very carefully at where the next shoe is going to drop in terms of weak banks, most obviously in the US, but in Europe too. And then on the policy rate side, I'm really waiting to see when or if markets will realize that a lot of the aggressive rhetoric about persistent inflation has maybe been overdone. The way I described it in my recent article for Hedder was that central banks have been shouting fire a little too loudly, and maybe they just need to calm the markets down a little bit as headline inflation starts to come down.
All right, Peter, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you very much.